Welcome to today's deep dive. It's fantastic to have you with us. Our mission today is simple, but I gotta say, it is certainly not easy.
No, not today. Definitely not.
Right. We're filtering through just an absolute mountain of business and financial news published on March 4th, 2026. We've pulled from a massive stack of sources: the Business Standard, Mint, the Economic Times, and our goal is to extract the ultimate signal from the noise for you.
Yeah, we're doing the heavy lifting here.
Exactly. So whether you're an investor or a business leader or, just someone who really wants to understand the forces shaping our world right now, you have exactly what you need.
And honestly, it is a critical day to be doing this. When you look at the breadth of sources we're analyzing today, I mean, they're entirely dominated by this massive, sudden geopolitical shock.
It's everywhere.
It is. We're looking at a severe escalation of conflict in West Asia, and the ripple effects, they're slamming into global markets with an intensity we really haven't seen in quite some time.
The contrast we're seeing in the news today is just absolutely wild. On one hand, you have this outright global market panic, just red screens everywhere you look.
Right.
But then on the other hand, hidden inside these exact same business papers, there are specific, massive corporate opportunities playing out right here in India.
Yeah, the duality is fascinating.
Yeah, it really is. I mean, we're talking about bumper summer sales projections for fast-moving consumer goods, a jaw-dropping $110 billion global media merger, and shifting tides in the pharmaceutical and auto industries.
You know, in moments of extreme market panic like this, critical thinking becomes your most valuable asset.
For sure.
It's very easy to just get swept up in the headline numbers and that sea of red you mentioned. But our job today is to spot the hidden patterns, right? The structural shifts that the broader market might be totally missing while it just blindly reacts to the immediate shock.
Okay, let's unpack this. By the end of this deep dive, we're going to give you the 10 vital developments every long-term investor needs to know.
The absolute essentials.
Right. But we have to start with a macro shockwave. The primary headline across every single major paper today is the conflict in West Asia. It's officially entered its fourth day.
And it's intensifying.
Yeah, the sources detail American and Israeli bombings, Iranian reprisals, and most critically for the markets, I think a blockade of the Strait of Hormuz. For those of us who aren't geographical experts, just how critical is this specific waterway?
So to understand the magnitude of this, we really have to look directly at the energy markets, and the geography is the entire story here.
Okay, lay it out for us.
The Strait of Hormuz is this incredibly narrow choke point between Oman and Iran. At its narrowest, it's only 21 miles wide.
21 miles, that's nothing.
It's nothing. And the shipping lanes themselves, just 2 miles wide in either direction. So the blockade of this specific strait is the absolute fulcrum of this entire global market reaction.
Because of the oil.
Exactly. 55% of all Asian oil imports pass through this waterway. 55%. It is entirely accurate to call it the jugular vein of global energy. Yeah, so when that vein is squeezed, or in this case, completely blocked, the entire global economic system feels the lack of oxygen almost immediately.
And we are seeing that lack of oxygen in the pricing right away, aren't we? I was reading the reports this morning, and it looks like the global benchmark, Brent crude, spiked over 7%.
7.25% to be exact.
Right. What does an $83 barrel of oil actually mean for the broader economy, like on the ground?
It means inflation. It really is that simple. Brent crude hitting $83.38 a barrel, and WTI West Texas Intermediate surging to over $76, it acts as a massive immediate tax on global growth.
Because everything requires energy to move.
Everything. Every single thing that is manufactured, transported, or consumed relies on that energy baseline. When the input cost of energy spikes over 7% in a matter of hours, every corporate margin on the planet shrinks, and the cost of consumer goods is just poised to rise.
Well, that explains the absolute carnage we're seeing across the global markets today. The Dow Jones tanked 900 points.
A brutal drop.
Yeah. Over in Europe, the Euro Stoxx 50 plummeted almost 4%. But the Asian markets took an even more brutal hit, didn't they? The Kospi dropped over 7%.
Yeah.
Why did Asia take such a disproportionate beating compared to the U.S.?
It comes right back to that 55% reliance on the Strait of Hormuz we just discussed.
Mm-hmm.
Asian economies, particularly these massive manufacturing heavyweights like South Korea, which the Kospi tracks, and Japan, they are heavily, heavily dependent on imported energy.
They don't have their own reserves to tap into.
Exactly. They do not have the domestic energy buffers that the United States has. So when the strait closes, the risk premium on Asian manufacturing goes straight through the roof. But what's really fascinating here is the underlying mechanism of the broader global sell-off.
What do you mean?
It's not just the fear of the conflict itself, it's what the conflict does to monetary policy.
Oh, right. Because for the last few months, the whole market narrative has been entirely about cooling inflation and an accommodating Federal Reserve.
Yeah. Right. Everyone was essentially holding their breath, waiting for those interest rate cuts.
Exactly. The market had priced in this perfect sort of Goldilocks scenario, falling inflation, steady growth, cooperative central banks.
But the sources note that market participants have now effectively erased their expectations for 2 Federal Reserve rate cuts in 2026.
Erased them completely.
Gone. A single choke point in West Asia has forced a total recalculation of global capital flows. Higher energy prices immediately translate to inflation fears roaring back to life. And if inflation stays high,
The Federal Reserve cannot cut rates.
they can't. Their hands are tied.
I noticed the bond market reacting violently to this as well. The U.S. Treasury 10-year yields surged 4 basis points. For anyone listening who might not track the bond market daily, could you explain how this ties into that inflation fear?
Sure. Think of a bond like a seesaw. On one side of the seesaw, you have the price of the bond. On the other side, you have the yield, which is basically the interest rate it pays out.
Okay, price on one side, yield on the other.
Right. When inflation fears rise, the fixed return on a government bond loses its purchasing power. So investors aggressively dump those bonds. They sell them off.
And when they sell, the price goes down.
Exactly. Which forces that yield, the other side of the seesaw, to go up. That surge to a 4.07% yield is the market screaming that it expects inflation to be stickier and interest rates to stay higher for much longer.
And when they dump government debt and they dump equities, they run for safety. We're seeing a massive safe haven rush into gold today. It just hit a 3-month high.
Which is exactly what you expect in this scenario. Gold yields nothing, it pays no interest, but it is the ultimate historical store of value when fiat currencies are threatened by inflation and global supply chains are threatened by war.
Absolutely. And to be absolutely clear for you listening, our goal today isn't to take a geopolitical stance or endorse any specific narrative from these sources regarding the conflict.
No.
We're simply here to impartially report on the severe economic realities and these massive capital shifts unfolding in the data.
Right, we follow the numbers.
Which brings us directly to India's shield and its vulnerabilities.
Yeah.
Because Dalal Street did not escape this macro shockwave today, the domestic market impact was severe.
Very severe.
The Sensex plunged over 4%. That is a drop of over 3,300 points in a single session. The Nifty dropped 4.12%. And I was looking at the foreign capital flight, the foreign portfolio investors, the FPIs.
Yeah.
They pulled out over 9,700 crore rupees in one day.
The largest daily pullout in 4 months.
Is that just a knee-jerk panic reaction, or are they fundamentally reevaluating the Indian market?
It's a bit of both, I'd say, but primarily it's a classic textbook flight to safety.
Yeah.
When global risk spikes like this, foreign capital tends to retreat to its home base or to traditional safe havens like the US dollar or gold, as we mentioned. Emerging markets, regardless of how strong their domestic growth stories are, always act as high beta assets.
Right. They amplify the global moves.
Exactly. When the world catches a cold, emerging markets get pneumonia in the eyes of foreign institutional investors. However, what is incredibly important to focus on right now is how the domestic infrastructure is actually responding to this pressure.
Well, the government's crisis management seems to have kicked in remarkably fast. According to the reporting, the Commerce Ministry has already operationalized an interministerial crisis squad.
Yes. And their specific mandate is to monitor supply chain resilience, assess export vulnerabilities, and secure critical imports. This isn't just a PR move either. This involves actively coordinating with the Navy, the Petroleum Ministry, and External Affairs.
And we really must not overlook the human element of this crisis. The sources highlight that there are currently 23,000 Indian seafarers stranded in the Gulf region right now, along with 37 Indian-flagged vessels just sitting in the Persian Gulf. Getting them out safely seems like an absolute logistical nightmare.
It's an incredibly complex challenge. You're dealing with war risk insurance premiums that are skyrocketing by the hour, the physical danger to the crews themselves, and the immense legal complexities of rerouting commercial vessels in an active war zone.
It's terrifying for those families, I'm sure.
Absolutely. And this is exactly why that interministerial crisis squad was formed so rapidly. The supply chain isn't just abstract containers moving on a map, it's operated by people. Securing their safety is the immediate prerequisite to securing the trade routes.
So we have the human element, and we have the broader energy element. Let's talk about the oil buffer. Because India imports roughly half of its total oil requirement from West Asia, the immediate assumption is that this is a doomsday scenario for the domestic economy.
Right, that's the knee-jerk fear.
But the sources suggest India actually has a 74-day oil inventory buffer. To play devil's advocate here, though, 74 days sounds like a decent cushion on paper, but if this blockade stretches out, doesn't that buffer vanish in the blink of an eye? Like, what happens on day 75?
It's a very fair pushback. Look, 74 days of combined strategic petroleum reserves and commercial refiner stocks, it is a significant shield against a short-term acute shock.
It stops a panic at the gas station tomorrow.
Exactly. It prevents immediate panic at the fuel pumps, and it gives the government some breathing room to source alternative supplies from Russia, the U.S., or Africa. However, you're absolutely right, that is not a permanent solution. The market price is in the future, not just the next 2 months.
Right.
If the conflict drags on, the cost of replenishing that inventory will be exorbitant, and that eventually bleeds into the physical deficit and domestic inflation.
And while the crude oil buffer might hold for a couple of months, the sources flag a massive, immediate vulnerability on the natural gas front.
Yeah.
The closure of Qatar's Ras-Laffan LNG facility. Why is liquefied natural gas so structurally different from crude oil when it comes to these supply shocks?
This raises an important question about energy diversity. Crude oil is relatively fungible. You can put it on a standard tanker and ship it pretty much anywhere. Liquefied natural gas, or LNG, requires incredibly specialized multi-billion-dollar infrastructure. The gas has to be super cooled to minus 162 degrees Celsius just to become a liquid.
Minus 162.
Yeah. Then it's transported on specialized cryogenic ships, and then it has to be regasified at the destination. You can't just put it in a normal barrel. And Ras Laffan in Qatar is the world's largest LNG export facility.
And India relies heavily on that specific facility.
Heavily. India utilizes imported LNG primarily for its industrial sector, particularly fertilizer production, and for its rapidly expanding city gas distribution networks.
So it's feeding factories and home stoves.
Right. And you can't just easily swap out a Qatari LNG contract with a different supplier overnight the way you might buy a spot cargo of crude oil. The ships are specialized, the routes are specialized.
But if Ras Laffan shuts down?
Disruption at Ras Laffan means an almost immediate spike in the price of natural gas in India. And that ripples through to agricultural input costs via fertilizer, industrial manufacturing margins, and everyday consumers cooking in their homes.
It's a stark reminder that energy security is a multi-headed beast. You can't just solve one part of it.
No, you really can't.
Now, I want to pivot us to a domestic data shift that might have gotten buried under the war headlines today. But it is absolutely vital for anyone tracking the Indian economy or managing an equity portfolio. There has been a massive overhaul in how India calculates its gross domestic product.
Yes, this is a foundational shift in the macroeconomic data. The government has revised the base year for GDP calculations to 2011-12.
I see this term base year thrown around a lot in financial media. For the listener trying to grasp the actual mechanics of this, what exactly does changing the base year do to the numbers?
Think of GDP calculation like tracking the cost of a massive grocery basket over time. Over a decade, what people put in that basket changes.
Right, buying habits shift.
Exactly. Maybe they buy fewer landline phones and more smartphones. Maybe they spend more on digital services and less on physical media. Rebasing is a standard statistical practice where the government updates that basket to reflect the modern realities of the economy. It just gives a much more accurate picture of current production and consumption.
But the outcome of this specific revision seems to be causing some anxiety. The sources note that the revision actually shrank the nominal GDP estimates for the coming years.
It did.
The estimate for 2024-25, for instance, was revised downward by 3.81%. Why did the economy on paper suddenly get smaller?
The crucial detail that every investor needs to internalize here is exactly why it shrank. The new, updated statistical series reveals that the old methodology was significantly overestimating private consumption.
Overestimating it.
Yes. Under the new, more accurate methodology, private consumption has seen a substantial downward correction.
Man, that feels like a massive revelation.
Yeah.
Private consumption is constantly touted as the primary engine of the Indian growth story.
It's the bedrock of the narrative.
Right. If you're an investor modeling out an FMCG company or a major retail chain or an auto manufacturer, your entire spreadsheet is built on assumptions about how much the average citizen is buying.
Exactly. If the new, more accurate macroeconomic data tells us that consumers are actually buying less than we previously calculated over the last few years, it fundamentally changes the valuation metrics of those consumer-facing companies.
So analysts are going to have to go back and completely scrub their models. If I'm looking at a company like Hindustan Unilever, and I thought the overall consumer pie was growing at 8%, but this new data suggests it was only growing at 5%, my forward earnings projections are suddenly way too aggressive.
It demands a rigorous recalibration of expectations across the board. Look, it does not mean the long-term Indian growth story is broken by any means, but it does mean the historical baseline we were using to project the future was overly optimistic. It requires a much more discerning eye when evaluating the multiples you're willing to pay for companies that rely heavily on robust discretionary consumer spending.
That makes total sense. And that transitions us perfectly into the sectoral deep dive. We've talked macro forces. Let's talk micro impact. Who are the winners? Who are the losers? And what are the strategic corporate shifts happening on the ground right now? Let's start with the immediate losers, aviation and logistics.
Yeah, the fallout in the aviation sector is instantaneous and severe. The sources detail absolute chaos in the skies right now. We're looking at severe route restrictions, total airspace closures over Iran and surrounding territories, and just numerous diverted flights.
For airlines like Indigo and Air India, the timing is just brutal. They were just finding their footing and recovering from previous supply chain headwinds with aircraft engines.
They're forced to fly significantly longer, less efficient routes just to bypass the conflict zones.
That burns more time.
It burns more time, and critically, it burns more of that aviation turbine fuel, which is surging in price, as we just discussed. It's a double whammy on their operating costs.
And the pain extends far beyond the passenger cabins into the cargo holds, doesn't it? The logistics sector is facing a severe cascading bottleneck. The reporting highlights that air cargo agents are actively petitioning for waivers on demurrage charges.
Yeah, demurrage.
Demurrage is one of those incredibly opaque industry terms. Can you break down what that actually means for a logistics company on the ground?
Think of demurrage like a brutally expensive parking ticket for cargo.
A parking ticket.
Right. When goods arrive at an airport or seaport terminal, the logistics agent is given a specific window of free time to clear customs and move the cargo out.
Okay, a grace period.
Exactly. But because flights are grounded, diverted, or hopelessly delayed due to the airspace closures, the normal flow of goods is totally shattered. Shipments are piling up at terminals, missing their connections.
So they're overstaying that free time.
Yes. So these agents are facing crippling penalty fees demurrage because their cargo is overstaying its welcome, entirely through no fault of their own. It is a perfect example of how geopolitical friction acts as a hidden, highly unpredictable tax on global trade.
That is brutal. Now let's flip the script. While aviation and logistics are taking a massive hit, there are unexpected winners highlighted in the sources today within the FMCG and consumer goods sector. And it has absolutely nothing to do with geopolitics, but everything to do with the weather.
It's a really fascinating juxtaposition in the data. While the Middle East boils over, India is dealing with the early onset of a brutal, sweltering summer. The sources report that temperatures are already hitting 33 degrees Celsius in Delhi.
And we're only in early March.
Exactly.
And for beverage makers and air conditioning manufacturers, a long, early, hot summer is basically their Super Bowl.
The analysis indicates a massive windfall for these consumer companies. Take SLMG, for instance. They're a major Coca-Cola bottler, or the leading consumer durable brands manufacturing air conditioners and refrigerators. They're projecting a massive 30% jump in sales.
30%.
Yeah. They are currently stockpiling their most robust summer inventory in years to meet this anticipated surge in demand.
It really highlights how hyperlocal weather patterns can completely override global macro gloom for certain sectors. If you're selling cold drinks or cold air, The threat of inflation or high interest rates takes a back seat to the immediate reality of a 40-degree afternoon.
People are going to buy a cold drink if they're hot, no matter what the Fed is doing.
Exactly. Okay, moving on to pharmaceuticals. This is where we are seeing a fascinating divergence in corporate playbooks.
The Indian pharmaceutical landscape is undergoing a significant structural shift right now. Historically, multinational companies, the MNCs and Indian drug makers, operated with a lot of overlap in the domestic market.
They were competing for the same slice of the pie.
Right. But now, their strategic paths are diverging sharply.
How so? What's the split?
The MNCs are doubling down on what they do best: high-end innovation, deeply complex patented drugs, and premium branding. They are effectively abandoning the lower-margin, high-volume, generic game.
Leaving that to the Indian companies, yes.
Indian pharmaceutical companies, on the other hand, are leaning entirely into their distinct superpower: massive, flawless scale, and the production of highly complex generics.
We have a great example of this in the sources today with Natco Pharma. They are rolling out a generic version of a critical cancer drug called pomalidomide in the lucrative U.S. market.
Which is no small feat.
Right. It takes immense technical skill to reverse engineer and manufacture complex oncology drugs to FDA standards, and Indian companies are really dominating that specific, highly profitable niche.
They absolutely dominate the complex generic space today. But, the sources also provided a truly fascinating historical nugget that shows Indian pharma hasn't always shied away from the bleeding edge of innovation.
I saw this.
The reporting discusses Zydus. Back in 2010, Zydus actually developed an oral GLP-1 drug.
I was reading this and my jaw absolutely dropped. GLP-1, like the active mechanism in Ozempic and Wegovy. The weight loss drugs that have essentially turned into a trillion-dollar cultural phenomenon over the last 2 years.
Yes, exactly that class of drug. Zydus had an oral version in active development 14 years ago.
That is insane.
They had the science. However, they ultimately shelved the project.
Why? If you have that kind of drug, why put it on a shelf?
Because the cost of running the required global clinical trials, particularly the phase 3 trials, needed to prove long-term cardiovascular safety. It was simply too exorbitant for them to shoulder at the time.
Wow. Can you imagine the boardroom conversations happening at Zydus today? They literally had the holy grail of modern pharmaceuticals a decade before it became a pop culture and financial juggernaut. That has to be one of the biggest what-ifs in corporate history.
It is a staggering what-if, but it also perfectly illustrates the immense barrier to entry in global pharma. You can have brilliant scientists, you can have groundbreaking molecules, but if you do not have the multi-billion-dollar war chest required to fund global multi-year clinical trials, the innovation stays trapped in the lab.
You just can't get it across the finish line.
Exactly. It clarifies exactly why the Indian pharma sector is making a pragmatic, strategic choice to stick to the complex generics playbook. The development costs are radically lower, but the manufacturing moat is incredibly deep and profitable.
It's a sobering reality check on the cost of innovation, for sure. Now, if we look at the technology and IT sector, we see a mix of turbulent storms and significant long-term silver linings. Let's start with the storm, because there is a very juicy corporate rumor dominating the IT sector news today.
Yes, there is.
Wipro is reportedly on the verge of losing a massive $100 million annual contract with the cosmetics giant Estée Lauder. And to make it sting even more, they're reportedly losing it to their fierce rival, Accenture.
That kind of severe client churn is a major red flag in the IT services sector. When a legacy client the size of Estée Lauder shifts a $100 million book of business, it speaks to intense pricing pressure and fierce competition for every single enterprise dollar.
It's a knife fight out there.
It really is. In a macro environment where global companies are deeply scrutinizing their tech budgets due to high interest rates, the IT service providers are fighting tooth and nail for market share.
It sounds like a race to the bottom on pricing. But the silver lining for India's broader tech ecosystem is actually happening physically on the ground, isn't it?
Yes, the structural news regarding physical infrastructure is incredibly positive. We're seeing global tech centers of excellence, or COEs, deepening their physical roots in India.
Deeper than before.
Much deeper. Historically, global tech giants would come in and lease vast amounts of premium office space in Bengaluru or Hyderabad. It was a flexible, somewhat transient footprint. If the macro environment shifted, they could simply not renew a lease.
But that transient model is changing.
Dramatically. Companies like Apple are shifting their strategy from merely leasing office space to outright acquiring large tracts of land and building their own massive permanent campuses from the ground up.
Why does that distinction matter so much to the broader economy?
Hmm.
A desk is a desk, right?
Because capital expenditure of that scale represents a totally different level of risk assessment. When a company the size of Apple transitions from being a tenant with a 5-year lease to being a landlord deploying billions in construction, it signals a permanent generational commitment to that specific talent pool.
They're putting down real roots.
Exactly. They aren't just outsourcing to India anymore. They are embedding the Indian workforce into their core permanent operational architecture.
That is a massive vote of confidence for the long-term tech story, completely detached from the quarter-to-quarter IT service contract battles.
Exactly.
Finally, let's look at the automotive sector, where we have a tale of two entirely different corporate strategies: aggressive expansion versus deliberate retreat.
The contrast between the two dominant domestic players is stark. On one side, you have Maruti Suzuki. They are aggressively revving up their domestic production capacity.
They're going all in on volume.
They are. They've set a public target to produce 4 million cars annually by the financial year 2031, supported by a massive new manufacturing plant in Haryana. They are betting heavily that the Indian middle class will continue to drive massive volume growth.
And on the flip side, you have Mahindra and Mahindra, or M&M, taking the exact opposite approach globally.
Right. M&M is drastically scaling back its international footprint. The sources report they're in the process of exiting unprofitable international subsidiaries in Turkey, the United States, and across various markets in Africa. They are deliberately shrinking their global ambitions.
It's a classic case of capital discipline.
Oh,
It seems like the market is currently rewarding companies that don't just blindly plant flags on maps for the sake of global PR.
right. The vanity projects are over.
Yeah. M&M's deciding that the smartest move is to consolidate their capital and dominate the highly profitable SUV territory they know best, right here at home.
Exactly. It's a shift from growth at all costs to profitable growth.
Okay, let's look at the broader regulatory and market environment, because we have crucial policy changes, an IPO to examine, and some truly staggering global M&A news that we really need to dissect. Starting with the regulatory environment, there is a major development tucked into the latest United States Trade Representative, or USTR, report.
This is a highly technical but incredibly impactful development. The report states that India will decide within the next 6 months whether to accept U.S. or international testing standards for American shipments entering the country.
For a business owner trying to import or export, what does aligning these standards actually accomplish? Why is this a big deal?
It's a potential game changer for international trade flows. Currently, one of the biggest headaches for foreign companies trying to sell into India isn't just financial tariffs, but non-tariff barriers.
Like voila.
Specifically, conflicting testing norms and product standards. If a U.S. manufacturer builds a product to U.S. safety standards, but India requires a completely different localized testing certification process, it adds months of delay and massive costs to simply bring the product to market.
So it's essentially administrative red tape acting as a tax.
Precisely. If India agrees to formally recognize international or U.S. testing standards, it dramatically lowers the friction of doing business. It could unlock a massive new channel for import and export plays, making the supply chain significantly smoother and cheaper to operate.
Domestically, there's also a major regulatory hammer coming down on heavy industry regarding climate change. The government is moving to make Carbon Credit Trading Scheme, or CCTS, compliance mandatory for the steel sector.
This is the definitive writing on the wall for heavy emitters. The government is no longer just politely encouraging decarbonization. They are moving to strictly enforce it through market mechanisms.
How does that actually impact a steel company's financial health?
Well, under a mandatory scheme, a steel manufacturer is given a cap on how much carbon they can emit. If they emit more, they have to go out into the open market and buy carbon credits from cleaner companies to offset their pollution.
So they're paying a penalty, essentially.
Right. For the steel sector, which is inherently highly pollutive, this means the cost of carbon emissions is about to become a hard, unavoidable line item on their balance sheets. It will force rapid adoption of cleaner, more expensive technologies. And investors need to seriously factor these new permanent compliance costs into their valuations of these industrial giants.
Here's where it gets really interesting for the equity markets. When we look at corporate earnings upgrades and downgrades across the BSE 200, we get a real-time pulse of how these macro and regulatory shifts are impacting the bottom line today. What stands out to you in the latest revisions?
The divergence in earnings revisions tells a really clear story about input costs and consumer pressure. Let's look at the upgrades first. Nalco, the massive public sector aluminum producer, is seeing major earnings per share, or EPS, upgrades.
And that's tied to the commodity cycle.
Yes, it's a direct reflection of the rising global metal prices we discussed earlier in the context of inflation. When commodity prices surge, the primary producers who mine and refine those metals see an immediate, massive margin expansion.
But the picture isn't rosy across the board. We are seeing some significant downgrades in bellwether sectors.
We are, and they are highly indicative of broader economic strain. Ambuja Cements has seen a severe downgrade from analysts. Their operating margins have contracted by a staggering 500 basis points.
500 basis points, that's a huge hit.
It is. That points to intense pricing pressure in the infrastructure space or soaring input costs like power and freight that they are simply unable to pass on to the end consumer.
And then there is Dixon Technologies, a major electronics manufacturer. The sources note their mobile segment growth just hit a 16-quarter low. A 16-quarter low. That is 4 solid years of data showing a distinct slowdown in mobile phone manufacturing growth.
If we connect this back to our earlier discussion about the macroeconomic data, it makes perfect sense. Remember the GDP revision showing a downward correction in private consumption?
Right.
Dixon hitting a 16-quarter low is the physical manifestation of that data. People are holding onto their smartphones longer. They aren't upgrading as frequently because their discretionary income is pressured by inflation. The macro data and the micro corporate earnings are aligning perfectly to tell the story of a strained consumer.
It's fascinating when the top-down and bottom-up data tell the exact same story. Moving to the primary markets, we have a notable IPO hitting the tape, Sedemic Mechatronics. They manufacture precision control units for vehicles.
It's an interesting technology play in the auto ancillary space. As vehicles become more like rolling computers, the demand for precision mechatronics grows exponentially.
The tech in cars is just insane now.
Yeah, it's all software and precision hardware. However, investors must read the risk factors in the prospectus very carefully here. The sources flag a severe customer concentration risk for Sedemic. They are heavily reliant on a very small handful of major manufacturing clients for the vast majority of their revenue.
So if they lose just one of those top-tier contracts, their revenue projections could essentially collapse overnight.
Exactly. It is a critical vulnerability. You have to weigh their clear technological edge against the fragility of their client book.
Finally, let's zoom out to the global corporate quick hits, because there is some absolute wildness happening internationally that highlights major shifts in technology and media. Let's start with media, because the numbers here are almost hard to comprehend.
The scale of consolidation in global media is reaching unprecedented, perhaps unsustainable levels. Paramount is reportedly merging with Warner Bros. Discovery in a staggering $110 billion deal.
$110 billion. But the detail that caught my eye wasn't the top-line number. It was the debt. The combined entity will be carrying a crushing debt load of $79 billion. In a world where interest rates are hovering around 5%, how on earth does a media company service $79 billion in debt?
That is the existential question for the entire industry right now. It is a massive, highly leveraged bet on the future of streaming and content dominance. To service that debt, they will likely have to ruthlessly cut content spending, lay off thousands of workers, and aggressively hike streaming subscription prices.
The consumer is going to pay for that debt.
Absolutely. It shows the sheer desperation of legacy media companies trying to build enough scale to compete with tech giants like Apple and Amazon, who treat media as a loss leader just to sell more Prime subscriptions or iPhones.
Speaking of tech giants, over in the defense sector, Palantir took an absolute beating today. Their stock plunged 38% following a scathing short seller report.
Yes, the report specifically questioned the viability, scalability, and accounting of their contracts with the U.S. Army.
And government contracts are their whole moat.
Exactly. Palantir has built its massive valuation on the perceived invulnerability and stickiness of its government contracts. When a detailed report shatters that illusion and suggests the government might not be as reliant on their software as the market believed, it causes immediate violent panic among institutional investors.
38% is a bloodbath. Now, in the robotics space, it feels like we're stepping onto the set of a sci-fi movie. Hyundai has officially entered the humanoid robot race, unveiling their Atlas model.
And they are positioning it to directly compete with Tesla's Optimus's robot. We're moving rapidly from the software AI wars like ChatGPT into the physical hardware AI wars.
Robots building cars.
Exactly. The legacy automakers like Hyundai realize that robotics is the natural extension of automotive manufacturing, and they are determined not to yield the future of physical automation entirely to Silicon Valley.
And speaking of legacy automakers, the boardroom drama at Toyota is straight out of a corporate thriller. The founding family is currently attempting a massive proxy battle to regain total corporate control of the sprawling conglomerate.
It's wild.
It highlights that even in the most established, historically stable global brands, the battle for strategic direction and the pressure to adapt to new technologies is constant.
No one is safe from disruption.
No one. We have covered an absolute whirlwind of information today, from the geopolitical tinderbox in the Strait of Hormuz, sending global energy and bond markets into a frenzy, to the fascinating realization that an Indian pharma company shelved the weight loss drug of the decade back in 2010.
A lot of ground covered.
We've seen aviation logistical nightmares involving demurrage fees contrasted against massive FMCG summer windfalls driven by early heat waves, and global tech giants buying up Indian real estate while domestic auto giants shrink their global footprint.
It is an incredibly complex, rapidly evolving landscape today. But as promised, we have synthesized this massive influx of news down to the absolute bottom line. Speaking directly to you, the listener, here are the 10 critical developments for long-term investors that we have impartially extracted from today's sources.
All right, get us with them.
Number 1, energy vulnerability. The immediate closure of the Ras Laffan facility proves the LNG market is highly susceptible to Middle East shocks. Investors must rigorously account for energy input cost volatility in the margins of any industrial portfolio company, especially fertilizers and city gas distribution.
Got it. Number 2.
Number 2, supply chain relocation. The rapid deployment of the government's crisis squad and the stranding of thousands of seafarers highlights that supply chain resilience is no longer a passing pandemic trend. It is now a permanent, unavoidable operational cost that global companies must bear.
It's just part of doing business now. Number 3.
Number 3, the FMCG weather premium. Climate anomalies like the early and harsh summer we're seeing drive a projected 30% sales jump are creating highly predictable, outsized seasonal revenue spikes for consumer durables and beverages. These weather patterns are now a vital forecasting metric.
Sell air conditioners when it's hot. Okay, 4.
Number 4, pharma's split identity. The defensive moat for Indian pharmaceutical companies is solidifying entirely around complex generics and manufacturing scale at a lower cost. While Western MNCs are commanding the premium, high-margin innovation market, understand which specific game your pharma stock is playing.
Don't expect Ozempic out of the generics makers right now.
Number 5.
Number 5, tech real estate. The structural shift by global IT giants from leasing office space to owning massive plots of land in India signals a permanent, multi-decade commitment to leveraging Indian talent pools. The traditional outsourcing era is transitioning to an embedded infrastructure era.
I love that framing. Embedded infrastructure. Number 6. Number 6, auto strategy divergence. We're seeing strict capital discipline being rewarded over blind global expansion. Mahindra and Mahindra's domestic consolidation versus Maruti's aggressive domestic capacity expansion shows that winning at home is the current priority over unprofitable international adventures.
Number 7.
Yeah.
This is the big data one.
Yes. Number 7, the GDP data reality check. The downward revision of private consumption in the new 2011-12 GDP base year is a crucial warning sign. Investors must rigorously scrutinize the consumer demand projections of retail, auto, and banking stocks, as the historical baseline for consumer exuberance was overly optimistic.
Recalibrate your models. Number 8.
Number 8, carbon compliance. The mandatory carbon trading compliance in the steel sector is the canary in the coal mine. Heavy industries across the board will soon face hard, unavoidable decarbonization costs that will significantly impact their bottom lines.
Number 9.
Number 9, trade standardization. The USTR report indicating a potential alignment with international or U.S. testing standards within 6 months will dramatically lower non-tariff barriers. This opens up entirely new, frictionless channels for import and export plays that simply did not exist yesterday.
And finally, number 10.
Number 10, the flight to safety. The immediate surge in gold prices and the massive 9,700 crore FPI pullout reiterate a hard truth. Despite incredibly strong domestic growth narratives, Indian equities remain highly tethered to global macro panic and the shifting winds of Federal Reserve rate expectations.
Thank you so much for breaking all that down. And thank you, the listener, for joining us on this deep dive. We have covered the globe today, but I want to leave you with one final provocative thought to mull over as you look at your own business or portfolio.
It's a good one to think about.
We've seen today how a single geopolitical choke point, like the Strait of Hormuz, can freeze global markets, and how regulatory shifts like carbon compliance can alter an entire heavy industry's balance sheet overnight. With global supply chains facing these continuous existential threats from both geopolitical conflict and unpredictable climate change, are we entering a new economic era where the most valuable companies in the world aren't necessarily those with the best products or the slickest marketing, but simply those with the most secure, unbreakable access to their raw materials? Something to think about. Keep questioning the consensus, stay curious, and keep diving deep.